All right, welcome back. My name is Chris Sachinelli, and I get to build, buy, and sell simple profit businesses every single day. And today we're here to talk about how to build wedge equity in our business. What is wedge equity? How do we manufacture it? And why should we care? Right. So simply put, wedge equity is the difference between the value of your business at the start or today, present value, versus at the end, right? So the difference between where it is to where it's going to be, the thing in the middle, that's the wedge, right? And when we talk about wedge, it's the incremental value or how we're making our business more valuable over time, right? So simply the present value, the future value, the thing that makes it more, that's the wedge. And as a business owner, we should care because wedge equity is ultimately how we grow the equitable value of the business, right? That's how we get better terms on exit, right? Or better valuations when it comes time to exit, better terms when it comes time to raise capital, right? So say you're taking your seed or your series round, you want to get a better valuation so you can negotiate better terms so that you can avoid, restrictive covenants into the deal. It's also a great way to, if you focus on building the wedge, you're also going to build a better business. So it's a great way to build a simple, profitable business. So say you're a bootstrapper building a lifestyle business where you just want your customers to be your number one investors, right? You still care about wedge because by manufacturing and building wedge, you're building a better, more profitable, sustainable business that ultimately is going to be able to support you, your family, your lifestyle that much better. So we should all care about wedge equity. But how do you build it, right? So what is this formula for wedge equity? We're Bootstrapper Capital, so we do build, buy, and sell simple, profitable businesses every single day. We're on our own investpreneur's journey of bootstrapping $100 million portfolio, 100% in public. We do it every single day. We do for ourselves what we do for ourselves, we also do for others through simpleprofits.io, which is our advisory firm. And everything we do is focused on building wedge equity, right? So we are committed to becoming the best in the world at building wedge, because the better you could build or manufacture wedge equity, the better you could get to profitable deals, right? So we buy companies, right? We buy, then build, and then we either sell or hold, right? But the whole goal at the end of the day is whenever you own an asset, whenever you own a business, you should be focused on building wedge equity, right? So that's why we care. And because we care for ourselves, we figured out this formula of how you can manufacture or financially engineer, wedge equity inside of a business. And we do this for our own portfolio companies. We do this for companies that we're looking to acquire, through our SAFER agreement, which is a simple agreement for future exit and revenue repayment under a performance-based capital structure. And then we also, yes, do it for clients as well, under the Simple Profits brand, which is our advisory firm. So when we look at wedge equity, we simplified. So again, Bootstrapper Capital, we're all about keep it simple, right? So we try to simplify into the smallest, fewest number of moving parts as possible, so that we could get very, very good at what's simple to get to great, right? In terms of simple, profitable outcomes. Right. So when we simplified wedge equity, because it's a very complex thing, right? Simple works, but simple is not easy. We break it down into operational equity and brand equity. So we have this simple formula that we use. We have a simple process that we follow to be able to build wedge equity. And it comes around focusing on operational equity. How do we improve operational equity, which I'll get into what operational equity is in a second here. And then also brand equity. The two of them combined equals the wedge, right? So a very simple formula, but complicated in terms of execution, right? But it works. So when we talk about operational equity, what do we mean, right? So operational equity can be broken down into a number of components. It's a much bigger conversation than this. Like operational equity onto itself could be its own video, let alone its own masterclass, let alone its own, journey that is investpreneurship and building a better business, right? Because simple operations definitely work. And if you can focus on operational excellence, right, you're building operational equity, you have a simple, profitable business. So I don't want to oversimplify the importance of operational equity. But when we're talking about it, it's really about, focusing on simplicity of operations, right? That's a lot of what we focus in terms of accountabilities, right? So we provide structure, strategies, and accountabilities when we approach building wedge equity. And a lot of the accountability is around simplicity of operations and then adopting the structures and the strategies to drive simplicity in operations. When we're talking about simplicity of operations, like that's a fairly complicated thing. That could be a pie in the sky, 100,000 foot thing, or it could be like a two inch above the ground, in the weeds type of thing. Because your business is a living thing, it's a machine. Realistically, we love to think of businesses as machines. There's lots of moving parts, and all these parts come together to be able to get to an output or an outcome, right? And ideally, that's simple, profitable, outcomes, right? Inside of simplicity of operations, you're talking about things like continuity of your strategy, right? Do people know what your vision, purpose, mission is? Do they know what the objectives are that you're trying to achieve? Do they know what the strategies are to be able to achieve those objectives? Do they know what actions they need to take? Right? Is there alignment amongst the team in terms of roles, responsibilities tied to those objective strategy actions, or OKRs as well? Right? So that everybody's coming together cohesively as a unified team with one vision, one goal, one milestone, one approach, that individually each player plays its role on the field to be able to make magic, right? And that's the form of simple, profitable outcomes. Alignment amongst the team. Also, like, these things drive additional incremental synergies. So not only is it like you're trying to make the machine work better, but you're also trying to, appreciate the parts, the components of that machine, specifically the people, right? Because you want to keep the things working for as long as humanly possible. It's like why you're a farmer, why you really maintain the tractor, right? Not to call people tractors in any way, shape, or form, but like you got to appreciate the machinery, the equipment, right? So you want to create like an optimal lifestyle. You want to really create a great working environment. And a great way to create a great working environment is to power people with simplicity. Like, tell them what they need to do. Like, what are we accomplishing, and how does it benefit me? Right? What do I need to be responsible for? And do I have what I need to be able to do it in the simplest possible way? Right? So I'm not worried and stressed. Like, I could just get my job done and then focus on the reality, which life is a real thing, right? We all have these things called lives. So you got to appreciate people in the process. This is a great way to do that. That's what supports this and supports a better business because of it. To drive that, you're talking about documentation of operations, right? Like documentation of operations, standard operating procedures, managing like folks in terms of what they're doing and who's doing what, why, how, right? That type of stuff. It's looked down upon because like it's typically approached as like an unpleasant experience. Like typically it's like micromanagement and things of that nature. But if you do it the right way, for the right reasons to get to the right outcomes, it can actually be a pretty pleasant experience. And the process of it, you're documenting the operations, who's doing what, how. If somebody does turn over, you have churn into your team, right? You're able to replace, teach, train, equipped faster, right? There's more continuity to the business. So it de-risks, de-levers the risk into the business. Most of operational equity is around delevering risk, which we'll get to in a little bit, right? Also by documentation of the operations and the alignment of the team, and then continuity to the strategy and simplicity of everything at its core, you're also going to have a higher likelihood of consistency, right? Because you want to sell a product that's consistently delivering the same outcomes to the customers. And if you do have consistency of the outputs, you're probably going to have higher customer satisfaction, right? So you're driving a better customer experience. And if you're driving a better customer experience to a more consistent output, around a process that kind of follows, with people that know what they're doing and they're happy doing it, right, into a very specific type of strategy, then likelihood of overall profitability is pretty high. So it kind of flows down a little bit in terms of these bullets, right? There's a why behind everything, but there's also a way to approach it. But that is operational equity. You're really trying to get to operational excellence, right? You're just trying to build a better business, right? Simple litmus test of if you have operational equity, right? Ask yourself 0 to 10, like how easy would it be for someone else to take over this business, right? I buy businesses, right? I actively buy businesses. If I was to buy your business tomorrow or today, right? How easy would it be for you to turn over the keys? And how easy would it be for me to take it over, integrate it, right? So you got acquisition and then integration, right? And then optimization. How easy would it be for me to integrate it so that I could stabilize it so that I could then optimize it, right? If it's difficult, I don't really want it, or it's it's not as appealing to me. You know what I'm saying? Like it's more work, right? So there needs to be a justification of cost, right? Your job is to get the maximum possible value. So you want it to be super simple, super easy for somebody else to be able to take over. That's what makes it more marketable and appealing. Also, for an investor who's putting money into your company, right? They want something that's consistent. They want something that is a known factor, less risk, right? Second question to ask: could a passive owner place an operator and run it for a profit? Right? That's a great litmus test. Meaning, like, I buy this business or you buy a business. You don't want to run the business. You're an investor. You're just placing, your job is capital allocation. You just want to place your capital, your money someplace, and then you want it to let it go and mature and grow and go make more money babies and things of that nature, and then come back to you someday, with an abundant family, right? More dollars. One of the ways that you do that is buying assets, right? So you want to turn your business from a liability, which is a job, right? Today, if you're running your business, you're working in your business, you have to show up every day. That's a job. That's not an asset, right? People, investors, buy assets. They don't buy liabilities. So could somebody just buy your business and then hire somebody at a salary from a percentage of that profit and then still get a return on their investment from what's left over with somebody else running it? If yes, that's a great asset. If no, you got a liability, my friend, and you got to change that, right? Brand equity. So that's operational equity. Brand equity is all about throughput, right? So we call it brand equity because we try to elevate it in the market, and we want you to focus more on like a perceived value, right? Which would be like a competitive moat over time, right? Because we want to keep you competitive, like the longest possible value when you talk about valuation of a company. A company that's going to be around for 100 years pushing out a profit to me is way more valuable than a company that's going to be around for 1 year pushing out a profit to me, right? Time value money. I want to collect as much money for as long as humanly possible on my assets, right? When we think about brand equity, that's kind of like what we're focusing on. We're trying to create a forever brand, right? We want something that's going to pay us forever because it's an asset, because we invested in the equity there. All of that, though, at the same time could, in the form of simplicity, you could say that it's the throughput, right? Or like how revenue flows through the business. Some people call it like the revenue engine, right? Some people just say sales and marketing, right? How you make money, the money more machine, right? Push the more button, right? That's what brand equity is. It's the revenue side of the house. It's the money making side of the house. It's the competitive advantage side of the house, right? So you want to focus on simplicity of throughput, right? A more complicated business is not as appealing as a simple business, right? Like if I could just simply make money, if it's like one step to make money, that's better than 2 steps, better than 20 steps, right? Also tied to that becomes like time value of money, right? Like how long does it take? How complicated is the business system for the throughput to flow through for me to collect my money, right? Like, am I selling something where now all of a sudden the throughput goes through, some sort of accounts receivable process where I'm not getting paid for 180 days or whatever the case is? That's less appealing than somebody that's just putting in a credit card and I get paid tomorrow, right? So it's all about simplicity of throughput. We're trying to improve and simplify your throughput, remove as many constraints as possible, build a better business. Tied to that is also cost of acquiring customers, right? So the basic 101 of business at the end of the day, especially the simple profitable business, you want the lifetime value of a customer, which is how much a customer is going to pay you for your output, your service, the value in which you're creating and delivering over the extension, the longest period of time, right? So how long can you keep a customer? And then how long, how much will they pay you while they are a customer? The accumulation of that is the lifetime value. The goal of business is to make sure your lifetime value is always more than your customer acquisition cost, right? So we like to focus on customer acquisition cost because everything starts somewhere. You're feeding the funnel. So you want to know what it's costing you to get a new customer. And then once you know what it costs you to get a new customer, you got to make sure that the lifetime value of that customer, how much the customer is worth, right, is more, because that equals potentially profitability, right? If it's less, then you're definitely losing money and it's definitely not profitability, right? Everything starts somewhere. If your lifetime value is greater than your customer acquisition, you're in a position of potential profitability. Then you got to look at the longevity of that business, right? So it's all about positioning the market, right? How long Do you have a competitive moat, right? How long will you have that competitive moat, right? Are you selling the right things? Is there more incremental revenue in which you can extract from the market, right? Are there adjacent markets in which you can go into, right? It's all about extraction of as much value in the form of money as possible inside of your asset, right? It's all about positioning inside the market over the long term. And then finally, like, you got to focus on your perceived value, right? The perceived value of a brand, right? Because that's a unique competitive advantage. Brand is a moat. It's a moat builder. It happens over time, right? Nike's a brand, right? A pair of Nikes is worth more than a pair of no brand shoes, right? There's value inside of the brand, right? You could have the same product, same output, same business system, better brand, more perceived value, a better competitive moat for a better business to pay you for longer, right? So a lot of what we focus on ties into that brand equity because it's forcing us to build a better business, both a perceived business, right, from a perception of value, but perception of value only lasts if you're actually delivering value. So we want to grow the perceived value as much as possible. And then we want to make sure that the actualized value, the realized value that your customers are getting in the market, meet or exceed that perceived value. And that's the goal. And that's how you're going to build up your brand equity. That's how you build a better business, right? Simple questions there to ask yourself, 0 to 10. How much time does it take for me as the business owner to recoup my customer acquisition cost? Meaning if like I'm in a subscription-based business, for example, and I'm selling a $99 a month subscription and it cost me $2,400 to land and close and convert a customer. That means it's going to take me 2 years of operating and servicing that customer before I'm into the point of profitability without any other operational expenses taken into consideration, right? Which means if I can't keep that customer for 25 months, then I'm losing money on that customer. So like you want to reduce that customer acquisition cost. It's way better if I'm making $99 a month. It's way better to have a $1 customer acquisition cost, right? So or a $99 customer acquisition cost or anything within that, and you're recouping it virtually right away, right? Deliver value, get to activation, onboard successfully, get to utilization, get to value adoption, right? It's an easier journey. So you can engineer that, you can improve that, you can optimize around that, right? Another question to ask, how long will I maintain a competitive moat in the marketplace? This is a loaded question because it's really two parts. First part is the assumption that you already have one, right? If you don't have one, you can't maintain one. So if you're like, I don't really have one, I'm not maintaining anything, that's a problem, right? Figure out a competitive moat. And if you do have one, know what it is, right? Again, market positioning, and then have a strategy in place to be able to maintain it for as long as possible. And if you feel like you're losing it, then you got to get competitive. You got to stay competitive. You got to improve your business. So it puts a sense of urgency on you to build a better business, right? Two great questions to ask whether or not they exist for you. And there's definitely a lot more, right? So those are just a few. So the fact of the matter is you can, if you answered 0 to those questions, that's perfectly okay. Everything starts somewhere. The good news is you can manufacture wedge equity. You can manufacture wedge equity by just building a better business, right? Get better at the game of business, right? That's why we love Bootstrappers. Bootstrappers are so phenomenal. We believe that they're just an elite version of an entrepreneur. It's a better version of being an entrepreneur because you're living in this reality every day. Like, when it's your own money, your own bank, right? You are the bank, you are the investor. And every single day, you're either making money or losing money, and you have a sense of urgency, right? Acting with that sense of urgency, you're focusing, you can really focus. You have a reason why to simplify. A lot of venture-backed businesses get super complicated, super fast for no reason, because the only reason is because they have a lot of resources, a lot of money, they could hire a lot of people. There's not a lot of processes. The strategy is kind of all over the place. There's no alignment through the organization, through the team. I mean, we advise growth organizations all the time because this is a very, very common problem. And we help them get to simple, profitable outcomes through simpleprofit.io by doing this type of stuff, right? But we see it, so we know it, right? When that's not a luxury, when you don't have that privilege, that luxury, right? and you got to just, put in the hard work and grit and grind, you get to simple faster, right? So, Bootstrapper Capital, like we live that life. So it's all about, simple, profitable outcomes and the art of simple. Right. So you could build a better business. This is a process, right? You can follow a process to build a better business. Right. So it's simple, but it's not easy, right? Simple works, but simple is definitely not easy, right? So for our process, which works, the first, it starts with implementing an operating system. So we've designed a business operating system. It's built on Notion, so it's super Bootstrapper friendly, right? There's no like additional incremental subscription tied to maintaining it. It's very flexible. They're constantly improving. They're integrating AI functions and things like that. Now it's getting even better and better and better. But realistically for us, it's a container. It's a container to be able to create a structure, right? So you want structures, you want strategies, and then you want accountabilities. So like what we did was we created a container that's very flexible. That's why we did what we did in the way that we did it, right? Anybody could easily adopt it, and then you could make it your own because every business is its own, right? Everyone is unique. But the goal is to implement an operating system, right? And ours could just be a starting point, and then you can go build something better. But the goal is to organize. You want to organize your business. We're always putting out fires, right? There's always things going on. It's easy to lose organization, right? Lose track of what's going on, especially from a strategic perspective. And the art of simple is all about having your strategy right? A simple strategy that really carries through the business. So you want to take intentional time, get organized. This is a great way to do it. Then you want to strategize, like what are we doing, where are we going, how are we doing it, right? So you want a section to focus on strategy, right? Because if you get your strategy right, then the rest of it falls into line. Then you standardize around that strategy. And then once you're standardized as a business, then you start to systematically execute and optimize, right? And build a better business and get to that operational equity. By standing up the operating system in the first place, you're building Wedge. Just by implementing an operating system, I'd say that you're going to increase the value of your company by 25 to maybe even 50%. In some situations, it could be 100%, right? A full return, right? Just by implementing an operating system. And there's a why behind it, right? The second thing that we focus on is to optimize your throughput, right? Again, that throughput, and that's to build brand equity, right? To accomplish the things that go into building brand equity, right? And there's math behind it, right? There's a why behind this stuff, right? So let's use an example. So say you have a really simple SaaS business and you're doing $1,000 a month in revenue, right? We see these types of deals every single day. There's a lot of them. The market's changing for sure. Cognitive applications, like everything's going to be going through this paradigm shift. So this stuff will likely change a little bit in terms of valuations. I think valuations are going to go down, multiples are going to go down, but that's another video. That's another conversation. This is where it is. We'll use this as an example. So say you have a simple SaaS, you're doing a K a month, a grand a month. Good, awesome. Especially if you bootstrapped it. That's awesome, right? First off, take a second, be proud of that, right? Definitely be proud of that. You built yourself an asset. If you do these things, you could sell it, you can exit it, you could get to liquidity, you could keep it, right? First off, not a lot of folks do that. So take some time, be proud of what you did, right? Next, let's talk about valuations. So you got $1,000 coming in. First thing you're going to do is multiply that 1,000 times 12 because that gets you to an annualized run rate. Annualized run rate, you're going to be at $12,000, right? So 1,000 a month times 12 is 12,000. Then we're going to add a simple multiple, right? And typical multiples for what we're seeing in the acquisition space into this is anywhere from like a 3 to a 5. They've been coming down, right? So we're using a 4 just to keep it simple. A lot of folks are trying to negotiate closer to the 3 range at this point in time. And then depending on your business and what type of business you have, right? Again, different types of industries, different types of business systems, different types of business strategies, right? Different types of business ways in which you monetize, like what it is impacts the valuation, right? Like an agency or service-based business is going to be valued different than a SaaS, et cetera, et cetera. We'll do a whole nother video on valuations and like the art of valuations and like how you focus on different things and different segmentations and you get to the math behind it. But this is simple. This also kind of stands up pretty simple for most across the board. It's a starting point for a conversation. So you're going to add a multiple. of 4. So take that 12, multiply it by 4, you got to 48, roughly $50,000. And that's a good actual like gut, right? So when you're talking to these deals and you're working with folks or you're building wedge equity, it's like typically every grand that you add incrementally a month in revenue, you're growing about 50K or so in terms of wedge, right? So like that's pretty cool onto itself. And then there's a risk ratio that comes in, right? So the risk rate, the goal here is to reduce the risk ratio to nothing, right? The risk ratio is how risky is this deal, right? So this is like this would be like standardized valuation. And then on a per deal basis, you're looking at it, you're diligencing it, and you're saying, how risky is this deal? Right? Because not all businesses are the same. No, you can't go get the same valuation, right? If you're an entirely different type of business with a different risk profile, right? Just the world does not work that way. The market doesn't work with like that. Sometimes you find dumb money and they think that it does, and that's good for you. You got a deal, but it's not really the way that it works, right? So there's going to be a risk ratio. We're going to diligence the business, like investors, buyers, etc. are going to diligence the business. They're going to say, how much operational risk is there, right? Like, is this business something that I could just put my money into and it's an asset? Like, am I buying an asset? Will somebody else be able to run this and I get paid? Or am I buying myself a job, a liability where I have to commit time, effort, energy, etc.? Right? Two different types of risk ratios. An asset is way more valuable than a liability, right? So, right? For obvious reasons. Then you have like other operational risks, like how much time would it take me to integrate this? Do they have their stuff in order, right? Is everything organized? Like how much time is it going to take me to close this deal, right? Like I could close this deal, in 12 months or whatever to get up and operational, or I can close another deal that has their stuff in order and be running next week, right? Which one do I want to spend time on? Time, value, money, right? I'd rather buy the deal that I'm going to get up and running faster with, right? Because they built a better operating system, right? And they have operational equity into them, right? So it's like, can I play somebody in? How long is it going to take me to take this deal over? How much trust do I have, like that their stuff is organized, right? Like how well documented is the processes? If there's employee turnover, can I teach, train, equip the employees to do the stuff? Right? Like all of these things become diligence questions in somebody's mind. And if you don't have a good answer for it, you're going to get hit with a risk ratio, right? And that risk ratio is just going to devalue your business, right? So you want to take away the risk, mitigate the risk to increase the value of your company, right? Same on the brand equity side, right? So it's like, is there a competitive moat, right? Hopefully there is. If not, that's bad. If there is, how long will it last, right? So like, for example, AI is a real thing right now. We're looking at a lot of deals because a lot of deals are coming on the market trying to get ahead of trend. But like you got a lot of like content sites that are coming up. They're trying to get, their rate now. Like the likelihood of that market taking a hit is really high because concept of search and like how those businesses get monetized is going to probably change. So there's risk at it. Like content agencies, right? You can go to Chat GPT and write a blog post in like 2 seconds or whatever. I don't need to pay a content agency, $15,000 a month to do that for me. So like there's a lot of shifts. There's a lot of market risk, right? So you got to see where your business is at, where it's positioned, and then if there's a risk ratio to it. The goal of building wedge equity is to reduce the risk ratio by focusing on operational equity, right? So that's the first thing you always want to do is you want to first de-risk the risk rate, reduce the risk ratio as much as possible. Again, that comes back to build a better business. Just build a better business, right? And again, by having the structure, strategies, and accountabilities, you can do that. Like you can legitimately do this stuff. You can move the ball down the field, right? You can have all the accountabilities in the world, but if you don't have the structures and strategies, you don't know what to do. What are you going to do? You could also have all the structures and strategies in the world, but if you don't have the accountability to do it, what good is it, right? You got to have all three: structure, strategies, and accountabilities. And then you reduce the risk ratio of the business by implementing and executing, and you increase the wedge equity. You increase the value of your company. The second thing that you're focused on is by increasing the revenue, right? So if we're using a revenue multiple to be able to drive the valuation of the business, which for the most part, these deals typically they revolve, around that to some extent for the most part, it's either that or a variation of that or some sort of anchoring around that. There can always be negotiate around it for the most part, because that's where, comfortability is in the market, when you're doing this stuff for a long time. So you want to just increase revenue, right? Increase revenue, but you want to increase revenue with the other things tied to brand equity in mind, like customer acquisition costs. Because if I'm just growing, revenue by spending a ton of money, and I'm spending way more money than I'm making, then like that's not really building Wedge. You know what I'm saying? So it's like you maybe want to invest in that. You want to grow your if you can retain customers, if you can deliver value, and then you can get to better lifetime value of the customer, right? Now you can build Wedge equity that way. But like there's simple ways to do it. And if you're smart, strategic, and methodical, you can do it, with less risk, and you can actually manufacture, a greater return on your revenue investment, to be able to build better Wedge by focusing on brand equity, right? So these two things combined, they build Wedge equity, right? Simple works, but simple is not easy, right? These are ways to actually do it. You can engineer it. This is like something you just follow in terms of a process. You could work every day, really focus your attention, really be accountable to your actions and be intentional to your decisions. And the byproduct of it would be building incremental Wedge. If you want a little bit of help doing this, if you like this content, first off, please like and subscribe for sure. We're always trying to understand what people want in terms of, content to digest. We're unique because we're a micro private equity firm. We do build, buy, and sell. We see a lot of stuff. We see a lot of deals. We're in a lot of deals. We have a lot of experiential knowledge, right? We want to share as much as we possibly can on this channel and other places as well. Please let us know in the comments what you're interested in. Like and subscribe if you're willing to. We appreciate that. We're trying to build up this channel, help more folks in this journey. If you yourself want a little bit more additional incremental help, you could visit us at bootstrappercapital.com. Check us out. We got a free community. You can come hang out, spend some time with us, get to know us. If you want to do a deal, reach out. We make it super simple for you to be able to get into a conversation with our deal team to be able to determine whether or not we could do something. And then we also have our advisory firm, simpleprofits.io. That's more of like a pay to play. Keep it simple. Like if this is something that you want, just do it type of thing. For all those reasons and hopefully more, hopefully we get to see you sometime soon. Thank you for taking the time watching this video today.